And look, we need to talk about your taxes because if you are a W-2 earner or a small business owner, you are being played for a fool. The government has created a legal, ethical, and honest system for you to pay zero taxes. It's not hidden. It's right there in the tax code, but no one ever told you the rules. This creates two contradictions that are absolutely insane. First, how can someone buy a $1 million property with $35,000 down and immediately get a $250,000 write-off that wipes out their entire W-2 salary? And second, how is it that the rich can buy a $15 million private jet and actually make money on the deal while you're scrambling just to deduct your $300 home office? It's like we're all playing Monopoly, but the wealthy were secretly given a get out of taxes free card. And my guest today is here to tell you how you can get one too.
This is the Epic Real Estate Podcast, contrarian takes on money, housing, and policy without the guru nonsense.
Let's go, let's go, let's go, let's go, let's go.
Let's go. Our guest today is the co-founder and COO of the CPA Dude, a full-service tax strategy firm dedicated to helping real estate investors and business owners keep more of what they earn. So please help me welcome to the show, Mr. Tony Hoong. Tony, welcome to the Epic Real Estate Investing Show.
What's up, Matt? Thanks for having us here today, man.
So I guess congratulations are in order. You're headlining a tax strategy summit as the keynote speaker this week. Is that right?
Yeah, we got it this Saturday right here. So big, beautiful bill updates and is dropping tax bombs all day.
Super. Where are you from?
Near San Francisco.
You're in San Francisco. Okay, got it.
Yep.
So
all in the Bay Area.
Let's just dive in. Tell me about the big, beautiful bill. What do we need to know?
Yeah, big, beautiful bill. This was the fireworks from July 4th here that they signed out. So it passed on July 4th. And the big thing that came in here for real estate investors, if they haven't been sleeping on a rock, is bonus depreciation. 100% is back now. If it didn't, it was going to be stuck at 40%. So we're talking about an extra 60% benefit now. So now it's 100% back. So it's permanent too. It wasn't going to be a phase down. Like it was going down 20% every single year. Mm-hmm. So now it's 100%. So right now it's time to buy, right? It's like, hey, it's actually prime time, about a quarter left. So get that in, and bonus depreciation applies even if you don't buy the asset at the end of the year. And, for the listeners that don't know bonus depreciation.
Yeah, explain that to me like I'm 12.
Yeah, this is the ninth world wonder of the world, I'd say. Compound interest is the eighth. This one's the ninth. Can't see, feel, touch it, but this is how the rich don't pay taxes. And what it is that the government gives you a fat write-off even though you don't pay for it. So let's say you have a down payment, $5 million home, FHA at $35,000 down, and you run some cost segregation studies, and you get $250,000 of bonus depreciation. So you just created a tax write-off over a couple $100,000, even though you didn't spend a couple $100,000. So it's essentially a big write-off that the government's going to front load you. There's this depreciation recapture though. So, it's always say, if it's too good to be true, it is, right? Mm-hmm. So, but it's a big benefit, and it's just robbing Peter to pay Paul today. So big deduction that you don't actually pay for.
All right. So the normal depreciation, you take the 27 and a half years thing, right? Okay.
Yep.
So this bonus where does the word bonus come in?
The word depreciation has got three flavors. Mm-hmm. You got straight line in 27 and a half year or 39 year. That's really slow. You got number 2, accelerated depreciation. So instead of 27 and a half and 39, now you got 5, 7, 15, 27 and a half, 39. And then the cherry on the top is the bonus depreciation. And what the bonus depreciation is that it takes the whole entire 5 and 7 and 15 year bucket, lights it on fire, accelerates all your expenses, and you get right out off on your taxes if you're, short-term rental operator or real estate professional status. For the normal long-term rental investor out there, not quite, right? All those losses you still get, but they're going to go into your passive piggy bank. You can't use them until you have positive passive income on that side.
Okay. So I buy this $1 million house. I use the FHA. Can you do the FHA on $1 million?
FHA, that's a good question. We got to loop in some of our lender friends on that. Maybe we go 10%. Yeah, maybe $100,000 down. Let's do that.
All right, let's do that. So we put 10% down.
Yep.
And so now we got a loan of $900, but we own $1 million asset.
Yep.
Okay, we know we talk enough about the traditional straight line of depreciation here.
Yeah.
So the accelerated would mean instead of over 27 and a half years, you take it faster, like in 5 or 7 years for a residential?
15, yeah. So that's some of the, because we all know as investors, the doors, the cabinets, they don't last 27.5 years. Those things get cost of garbage and trash by tenants.
Yep.
So, you're realistically, if you could last 5 years, now you get depreciate over 5 years. So say you have $100,000 of 5-year property, instead of over 27.5 years, which is barely, a few grand each year.
Mm-hmm.
Now you pay $20,000 each year with accelerated depreciation over a 5-year useful life.
All right. And then the bonus, you get to take all of it at once?
Yeah, the whole shebang, my friend, the whole enchilada, instead of $20,000 for the next 5 years, now you get the $100,000, all of it. And the key part here is that it only applies to useful life that has 20 years or less. So it's 5-year, 7-year, 15-year. The stuff that's 27.5, like the 2x4s and the roof, you don't get that. So anything under 20 years, you get lighted on fire the first year. Take the whole thing.
Got it. Okay. So now you said something there earlier. If I close on December 31st, I can't do it with the residential long term. I have to wait till it produces a positive cash flow.
There's areas of debate on this. So there's some CPs that say as long as you place it in service and you list it out for rent and they take those aggressive positions, we don't get that crazy over here. We like to actually see real income come through, because you show a fat zero and negative $100,000 on your Schedule E, it's not going to be pretty. The IRS might be knocking. So, if you show $2,000 of rent, you got the lease agreements and everything, that's going to look a lot better. So, maybe at least get some money in. But if you got the gift of gab and you can make it launch and it's turnkey, sometimes by turnkey, you got renters inside that pay rent, that could actually work.
Got it. Okay. I like it. Now, when you go to sell it 10 years from now,
yep,
you got to give it all back, right?
Yeah, exactly. So that's why I say if it's too good to be true, it is. So you took all the benefit 10 years ago. Now it's just like, all right, now you got to either pay it back. But what most smart real estate investors do and how generational wealth is built, 1031 exchanges or opportunity zones, right? So, or you don't even have to do those two. You can add in the third one, the lazy 1031 exchange. But this is where tax strategy and planning is so big. And that's pretty much, all we yell and preach. I'm a broken record. I'm always say, if you fail to plan, you plan to fail. Ben Franklin, our favorite friend, on the $100 bill. So it has some planning strategy in place. But yeah, once you sell it and you don't do any of that, so let's go worst case scenario, you got depreciation recapture. So you have to pay back all the benefit that you took, but there's a slight arbitrage here. And that arbitrage is that depreciation recapture is only subject to 25% max tax rate. So if you're a high income earner, you're at 37% federal and you only pay it back at 25%. So that 10 years ago, you had 37%. Fast forward, you're still at 37%. You're actually arbitraging the difference of that 12%. So it's not bad. And then anything in excess of ordinary would just be long-term capital gains rate anyway. So, maximal federal 23.8 and then whatever state you have.
Got it. All right. And I'd imagine that inflation eats this all up too.
Oh, yeah.
Right?
Inflation. Yeah. But there's the tax world that, me and my team live under a rock on. And we see that. But unless you come up for fresh air and you really understand what's going on in the market, inflation will kill you. We all know everything has gone up in the past couple of years here. So, yeah, it's a lot there.
No, but I mean, as far as the payback goes, you win on that side too, because you're paying back.
Oh, in terms of and tax dollar wise, yeah, because you haven't been subject to, you protected your money because you took all the money that first year. So time value of money principles, $1 today or $1 tomorrow, my friend. We always take the one today. So
Correct.
That's why you want to be mindful of how you want to plan out your tax strategy, and that's why having something in place is better than nothing in place.
Right, and that brings us to tax planning. Like that's everyone's favorite thing.
Oh, hey, that's my favorite, I tell you.
No, I know. I mean, if you're making money, it is a very exciting thing, right? If you're struggling to get there and get to where you want to be in life financially, then it's not as exciting. But it should be. You should still plan at that level, right?
Oh, always. Yeah. I mean, I tell people, you don't even have to make big bucks to tax plan. You can be working W-2, $50,000. Your tax plan is 401k, HSA, FSA. I mean, hey, you got $5 left for traditional IRA. Boom. That's a tax plan. You did something, then nothing. And I always tell people this. If you save $10,000 a year, say that comes from your tax savings, and you compound that for 30 years at 8%, that's $1.3 million. $300,000 being a tax savings, $1 million being the eighth wonder of the world, compound interest. Right? So do some planning. You don't even have to be like filthy rich. You can make $60,000. Actually, This was actually a story for me. I bought a house during the crash, just during college, had nothing, but the house is $40,000, right? And it had nothing going on with it. And I came out of college making $54,000, but the house that year had some bad repairs, and there's the mom and pop deduction. A mom and pop deduction for real estate investors is if you make $100,000 or less and you have losses, you can take $25,000 of losses against your active income without being real estate professional status or short-term rental loophole. So I got, a little refund that time. I wasn't paying that much in taxes, right? But that's just goes to show that real estate, it doesn't discriminate 100% on just how much money you make, right? If you can pick up some cheap pulse, especially in the Midwest. I'm originally from Minnesota. Before I moved out to San Francisco, I was literally walking, breathing example of this.
I've always said that. I've never done the actual math for people. I just say as a general statement, because I know it to be true, that if you're just the median household income in the country and you pick up 3-4 income properties, even if they never cash flow, you essentially will never pay taxes again.
Exactly.
Right?
Exactly.
That alone gets you out of the tax talk. Legally, honestly, ethically, it's right there in the tax code. And so
exactly. There's no other asset class where you can invest, make money like in your pocket or on your bank, and then look poor on paper and not pay any taxes, right? Yeah. Even as, let's say you deal with properties, $100 a month, right? That you can cash flow. That's everyone, right? It's $1,200 a year, but you don't have to pay taxes on that $1,200. There's nothing else in the tax code that allows you to make $1,200 of profits and not pay any taxes. Real estate's that one asset class.
People complain about inflation. They complain about taxes. And I say, well, just buy some real estate. And they said, oh, no, the market's going to crash. I'm just like, that's your hedge against the inflation and the taxes. But anyway, it's funny. So what else is in the big, beautiful bill that we need to know about?
Yeah, so 100% bonus depreciation was number one. Number two now is going to be the SALT cap. And it's not the table salts we're talking about. We're talking about the state and local taxes here. And what this was that you get the first 10. So this is for property home owners, right? That's for your own primary. You got $10,000 between property taxes and income taxes. And if you had more than $10,000, and this applies if you're married joint even. So the people that got married got screwed on this in 2018 of the tax code. And if you just say you had, so I'm in California, everyone, their house property tax bill owns $10,000. In order to pay that mortgage, you're well making $100,000. So in that tax alone, you're probably paying $18,000. You only got the first 10, lost out on the other 8. So now for the next 4 years, this phases away though, is that you get up to $40,000. So it increased 4x on this side. So now you can have big deductions. So the property tax bills won't hurt you. Your income tax bills won't hurt you. So this only one, that's it. If it's too good to be true, it is. This is only if you make up to $500,000. They'll give you the first $40,000 of state and local taxes as a deduction. Once you're past 600, you go back to 10,000. In between 5 to 600, there's a phase down. So you get somewhere in between that 10 to 40 grand. So that was huge for property owners to have huge property tax items and they pay income taxes at the same time. So, our folks in Texas, they don't pay state income tax, but, their property tax bills are huge. So this actually could be a huge benefit for them just because they're stuck at $10,000.
Yeah.
So that was really good. And also, if you're on that cusp of that 500 to 600 mark, you don't think that you lost the game. You can tax plan, get your income down to 500 or less, and still qualify for this. That's why, like my broken record always says, you need a tax plan. But I'm like that old nagging mom. He just won't be like, hey, you got to brush your teeth. You got to brush your teeth. I will always keep on yelling tax plan until I die. So you don't lose out just because, oh, okay, never mind. I make 600. Okay, no, you can do something. Reduce that 600 to 500. Now you get the full 40. So that was the second big thing that came out of the big, beautiful bill here.
So, all right, cool. So just before we leave the SALT tax, so we can take our property taxes and our state income tax, and as long as they don't exceed $40,000, we can deduct that from our federal tax.
Yep, exactly.
Right.
Yep. Okay. The standard deduction, you take the itemized deduction now. So itemized deductions look a lot more attractive now.
Got it. All right. So now if you make $600,000, gosh, Tony, I don't want to give $100,000 back just to be at $500,000. How do we show that I make less income?
Oh, there's many things, my friend. So, one, the topic here, real estate, right? Either you got to be real estate professional status though, or short-term rental loophole, right? That's one that's our go-to bread and butter for our company, for our real estate investors. So you got to do that. So that can be that. If you don't, now you got to get creative. You better max out your 401ks. Where's your income coming from, right? 401ks, can you step up? Employers, if you're self-employed, put $70,000 into it. If you're, more on the self-employed side, the government really loves real estate investors and business owners. So the tax goes written for them. And the other part is the defined benefit plans. So it's what do you call it? A retirement plan on steroids. And you can stash even more money into that. And then the last part of how the tax code's written is for charity. And we've had, started diving into this new strategy where we're setting up foundations, because a lot more people are purpose driven now versus financially driven, right? What's the purpose behind what they do that helps them with the financial? And setting up private family foundations. You don't have to be Bill and Melinda Gates Rich Foundation to have one. You can actually have one now, and you can put 30% of your income into it and then carry out the foundation parts. And if you got your retired mom and dad, or the brother, sister that hasn't really, done too much in their own life, that's what happens. Athletes do this all the time. Staff on foundations, they hire all the friends that to run out that, and you can shave worth 30%. So if you're at 600, start your own foundation, put 180 grand. All right, we're down to $420,000.
Yeah, you're gonna write all your family and friends a check anyway.
Yeah, right. Exactly.
Got it. It's like paying my son's allowance, right? Yeah, I make him an employee, and all of a sudden he's a tax deduction.
Exactly. And they got to work and teaches great work ethic on that side. My mom put me to work at 11 years old at her Chinese restaurant. So it's, hey, put him to work. I think she paid me $400, but it went to an account I never got to see. So only money I got to see was the tip money on the tables.
That was my first job, of washing dishes in a Chinese restaurant.
Oh, there we go. There we go, my friend. Yeah, you know how it works over there.
I did. $3.10 was minimum wage when I did that.
Oh, there. You've grinded it through. Yeah.
Okay, so let's go back. I don't know if this has changed or not. I haven't looked into it. I haven't really had to. But what constitutes a real estate professional? How do you qualify for that these days?
Oh, yeah. Real estate professional. This is big for, it's generally married folks, right? You got the one person making tons of money. It's always the doctor, software engineer, and then you got the real estate professional at home, aka the home taker, the real estate taker, the portfolio manager. 750 hours, at least 750 hours. Hoop number one. Hoop number two now is over 50% of your time in the trades or businesses, real estate. There's 12 of them. More likely than not, the ones that you're going to qualify are property management, operations. If you're a real estate agent, that does qualify. Also, there's bad news from bad CPAs that don't know real estate and say, just get a real estate license. You'll qualify for real estate professional status. Like, no. You have to hop through these two hoops. And the last one that gets most people is called material participation. There's 7 tests. The easiest one, the meat, is 500 hours, and you group all your properties together. And then anyone else can work more than you. So as long as you work 500 hours on that. So of that 750, you pretty much make 750 as operations. Or there's another prong that says 100 hours and no one else works more than you on each property. So there's a couple of tests, but those are the 3 hoops you got to hop towards. But it is more, people do kind of try to claim this, but you guys see those audit logs, they'll poke at it. We have IRS tax auditors on our team. If they said the easiest place where they poke logs is like, hey, where's your time log? They don't have it, you lose an audit.
So of those 7 tests, how many of those do you have to pass?
Just one.
Just one. Okay, got it.
Yep.
So you said that when someone gives you the advice, just have your wife go get a real estate license. Why doesn't that work as advice all by itself?
Oh, yeah, exactly. Because you're not doing the material participation, you're not doing the 500 hours operating your property. So you actually have to do material participation in the activity that you're trying to offset against, aka the rentals. So you
right. But if they're an agent, if your spouse is an agent,
yep,
they have to show their participation in the business, is what you're saying, basically.
Exactly. To show their participation in managing the rentals. Exactly.
Okay. But I mean, what if she's just a agent? She just sells houses.
So she'll qualify on that 750 hours, over 50% of her time, but will fail on material participation because she's not actively managing the rentals. So you won't get any losses though. But let's just pretend though that her agent business or his agent business loses, $30,000 because they're getting things going. They bought the new car, run a whole bunch of ads. That $30,000 will offset the spouse's income though, just because it's an active business. Right. So there's still silver linings in all this.
Okay, so then I'm sorry to circle back, but now I'm unclear. If your spouse is an agent, you also have to own rentals.
Yeah. Otherwise, because the key part is you want the depreciation to reduce the active income from the working spouse from the other person.
Oh yeah, it does. So it wouldn't make any sense. Okay, duh.
Yep. Oh, you got it. Oh, this is this. Hey, man, I say taxes are silly, confusing.
No,
And they did that on purpose. And you just got weird nerds like me who love it.
no, I've been talking about this for 20 years and I knew that, but then we narrowed it down to just had to pass one of the 7 tests. And then that's where my brain went blank. So, all right. So that's real estate professional. Tell me about the short-term rental loophole.
If you've been grinding for deals and coming up empty, you're not alone. That's why we created a way for frustrated investors to finally get cash flowing income property without the hassle. Go to frustratedinvestor.com. And now, back to the show.
I hear about that a lot. Explain to me exactly what that is.
Oh, short-term rental loophole. This is great. You can work W-2 and pretty much pay no taxes. So what it is that you more or less have an Airbnb, self-managed or whatever. And with the hoops you have to hop through is an average stay of 7 days or less throughout the whole year. So total days divided by total stays. As long as that number equals 7.0, you meet number 1.
Okay, what's that equation? Hold on, what's that math equation?
Oh, yeah. Total days.
Total days within a year?
Yep. Within a year that you rented it out.
Okay.
And then the total divided by total stays. So that would just be, so you can have 1 30-day rental. Then you have 10 2-day rentals. So then we're at a total of 11 stays, and we're at a total of 30 plus 20, 50. So we're at 50 divided by 11 here, and we're just right under that 7.0 number. So you can actually have some long stays, but you ever have a crap load of small stays too. That number just has to be 7.0 or less.
Okay. So the total days is how many days somebody is staying in the property. Right.
Yep. Throughout the whole 365 day or 366 day.
Okay. And then the stays is like the individual tenant or the individual person.
Each stay that they booked on Airbnb. So say like you had booking for this weekend for 2 days.
Yep.
That's 2 day, 1 stay. And then next weekend they did 3 days, 1 stay. So now you have 2 stays and you have 5 days total now.
Got it. All right. So then you add those up and then divide them by each other. And that has to be 7 or less.
Yep. Exactly.
Got it. So what's the minimum? Where does this pass at the minimum here? Say we just
11.0 or less. Yep.
But let's just say we did weekends. How many weekends a year would that be?
Oh, weekends. I mean, if you just had all weekend stays, you can just have a couple stays for the weekend. So if you want to buy one, you're listening to this right now and you want to buy a short-term rental, close within and launch in, November, just stay a couple weekends and add a couple of days and you're good to go. You meet criteria number 1.
Oh, just 1 weekend. Cause 2 divided by 1 is 5. Or be
0.5. 2 weekends, 5 days. Yeah. 2.5. Yeah.
All right. So you have to rent it out once a year then.
Yeah, but I mean, you might lose some money, but yeah.
that would qualify. Okay, so now you qualified for that. What does it actually get you?
Oh yeah. And then the second one too, just here you got to hop through 2 hoops. Material participation, which we talked about already. But generally speaking, the easiest one to meet is 100 hours and no one else works more than you. So then in terms of everything what's the whole point of doing this? Is now, let's say you buy that $1 million house and then you get $250,000 of bonus depreciation.
Yep.
And you make $250,000 as a W-2 income earner. Guess what? 0 taxable income, fat refund for all the withholdings you had for that year. So you pay 0 taxes this year.
So it's dollar for dollar?
Almost on the dollar for dollar on the taxable income side, but not for your tax liability. Tax liability. So say if you make $250,000 and between state, on the Fed side, about 25%. On there. So, you pay that. And then, so it's only 1 towards 25%. But say if you made $250K as income, $250K of depreciation, that is dollar for dollar. Dollars deductions offset dollars earned.
Got it. Okay. I understand.
Yep. Not taxes though. Taxes is always towards your effective tax rate.
Got it. Okay, cool. I'm there. All right. So now let's go to how we're reducing our income. Let's go to the retirement planning you're talking about. You could stash more away in retirement.
Yeah, retirement planning is huge. There's so many flavors of it, but the big ones that we really can see for real estate investors is whether it's a self-directed IRA, so you can draw back money out to invest, or if you're a business owner who needs more money and starts to become a real estate investor, the solo 401k or the SEP IRA. I personally like the solo 401k if you own your own company, or just a normal 401k. Like I said, there's many flavors, but what you can do is you can contribute $23,500 as the employee, and then the employer, you can do a 25% match up to $46,500. So this year, 2025, you can put $70,000 away from Uncle Sam. So sometimes I joke and I call him Uncle Scam, but it's you got that. And then if you got a spouse, now you can do $140,000.
Okay. Let's go back to we make 600,000. We want to get to 500,000. So we have $100,000. So if we put that $100,000 into a retirement account, we don't show that $100,000 as income.
Exactly, my friend. You got it down.
Well, that's cool.
Oh yeah, we can go on days on days. We got strategies.
Yeah, I'm trying to slow you down so everything can be actionable for anyone that's listening. So that's good.
Oh yeah, definitely. I'm just too excited just to save people money here.
Right? No, I love it. That's when you're passionate about your thing. That's who I like to talk to. I like it. We've got the big beautiful bill. We got 100% bonus depreciation. We got the salt cap. Is there a third one?
Oh yeah, there's a third one too. There's a ton actually. I got this little cheat sheet too. So if anyone wants to just DM me on Instagram, the CPA dude, and just DM me BBB, we got automation set up, and then you will just send you that full guide here for you. There's a ton out of big beautiful bill, but the one that I want to leave us here with today is solar is going away though. So for all our real estate investors or even primary homeowners, the solar tax credit for the primary ends this year, and then the one for rental properties can end next year. But that's 30% discount on your solar panels. So that's going to go away. The new bill was not very eco-friendly. So, and then actually, you have until the end of September to get the EV tax credit for your car. That's $7,500. But going back to the solar panels. So say the solar panels, I see this on tax returns all the time. 40 to 60 grand is the system cost. So let's say it's a $40,000 system. You would get $12,000 as the tax credit. So then it's $28,000 out of pocket for you. Your electricity bill over time, depending on where you're at, it'll pay off pretty fast. 5 to 7 years if you're in the higher part. But if it's cheap electricity, then may take maybe double that. But that's going away at the end of this year for primary homes. And I'm telling a lot of our clients right now, I'm like, if you ever want solar, right now is the time to go get it.
So you could still get it now and still get the benefit, but after this year, you can't.
Yeah, exactly. That's 30% off. And it won't come. I don't know if it's going to come back unless the next president, they're more eco-friendly on that side. But yeah, it's 30% gone. And who knows, you're stuck for 4 years at least unless they change it. But I would take advantage of it now.
So what was the reason for that?
Oh, the reason? My conspiracy theory is when Elon and Trump had their lunch shenanigans together, it was just kind of just a kick there. But truly,
I think Trump was just being vindictive against Elon. That's why he took it away.
And that's my conspiracy theory. But what they needed to do was that this bill was very costly in terms of the deficit it was going to create. So they needed to cut.
Okay, that makes sense. Yeah.
All jokes aside, yeah.
No, I got it. I was just trying to figure out because there's a lot of talk right now. I just listened to something this morning on how just the whole green energy, the global warming. How this is just all kind of this is the biggest scam pulled on the American people in ever. How the global warming works. And I was like, huh. Anyway, I know that's not your expertise, but
I don't know much about that. Yeah.
But I'm just saying the solar and the electricity and all that kind of everyone's kind of not, they don't really care about that anymore. You know what I mean? There's much talk about it.
Yeah. They're de-incentivizing people to go that way right now based on the tax law.
So that means those guys come knocking on my door trying to sell me solar panels all the time. They're going to disappear.
Oh, they're done already, my friend. I was talking to the rental one. They're done. They pivoted. I don't know where they're going to be now. So those guys aren't knocking on your doors anymore because there's no more tax credits to sell. It's not lucrative to even have it. No one wants.
They're going to be knocking on the door selling bonus depreciation is what they're going to do.
There we go. Now we're talking. Yeah.
There's a business. Super.
Yep. Exactly.
All right. So let's see. Let's say someone is just starting a business and they start their business. They're going to be a real estate investor. They're going to be a landlord. That's going to be their business. So they kind of kill two birds with one stone. They get the benefits of both, of the real estate and the business ownership. What's the first thing that they should do when it comes to their tax planning and just thinking of taxes in general?
Yeah, first thing they should do is get some tax plan in place. And that tax plan, like I said, it doesn't have to be super crazy. It can be super easy. But, I always say, part of our system and how we do things is first your entity structure, right? Mm-hmm. Number 2 is going to be your bookkeeping and your FP&A, your financial planning. So how are you going to do your bookkeeping? Also, what are you forecasting to make this whole year? And then from there, you kind of have some decent foundations. And from there, now we can build up, okay, we're going to make $70,000 this year. All right, how are we going to reduce that on taxes? Pull out the tax toolbox and be like, all right, I'm going to pay my kids. I'm going to put a little bit of money towards charity. Also, I'm going to do that retirement part, put some money in the self-directed IRA, and then buy that property, take bonus depreciation on it. Boom, I'm down to 0. So those are just the initial few steps you want to have to do. But yeah, just contact a tax strategist and then boom, let's just talk on that side and see if there's a way to help you out.
Awesome. Do you know any good ones?
Yeah, decent. Yeah, this is some guy into CPA, dude.
Awesome. Yeah, looking back, I wish I would have hired a bookkeeper much, much earlier than I did, because
Oh yeah.
it was a pain in the ass to go back and fix all that stuff.
Oh yeah. Amen. Preach, my friend. There's some people I'm always shocked by this. When we go to tax filing time and I'm like, hey, can I get the income statement for your property? And they're like, I don't have it. I'm like, you told me you just put in $100,000 into investment that you have not monitored for the last year. Like, are we just praying and praying here? Like, if I invested $100,000, I want to see how this is performing on a monthly basis.
Correct.
You can check your stock accounts every day. Why aren't you checking your real estate portfolio at least a monthly basis?
Yeah, totally. Yeah, it was very expensive to go back and retroactively fix all of my books. And
Oh yeah, pro tip there. Yeah, and it doesn't have to be that bad at all. On our
bookkeepers are not that expensive, right? But if you ignore them, they can be very expensive.
Exactly. Like there's one person, she had bad bookkeeping. I found $28,000 that she missed. And I was like, I only charge you $150 a month if you're on our membership for it. So I was like, I just paid off my fees for a long, long time, my friend.
Totally. That's a good close for the CPA guys. My first CPA said that. He said, I was like, you're too expensive. And he's like, okay, I won't charge you anything if I don't prove to you that I saved you more than what you're going to pay me. I was like,
Anyways, Max, that's how we work too. You come into our world, let's see if we can even help you. We'll check out a blueprint. We'll refund you in full. We can't. And then, hey, part ways. You know, it's an easy business to be in. You can literally see it and prove it out in numbers.
what's one piece of, say, common tax advice that you hear that you just totally disagree with?
The first one was that get a real estate license and you're good to go. That's one on that one. A second one I would say is, but it's like the buying a car and it's letting the tax tail wag the dog. Like they'll let the tail wag the dog. So like you're buying stuff you don't need. So like, you know, a lot of our real estate agents, they want to buy fancy, nice cars. Like I got to show up to the house looking real fancy. And I'm like, your car's 2 years old and it's beautiful. You don't need a new car. So getting write-offs that don't have an ROI, I would say that's really bad advice that I would see out there. And then the third one is everyone does this, not everyone. 80% of the population does this every April. They just file their taxes and don't do any tax planning. Like literally they just don't do tax planning. I'm almost like, would you build a house without a blueprint or would you go work out without a workout plan?
Right.
I don't think you would file your taxes without a tax plan. So that's the big thing. Like they didn't even do anything. And like I said, it can be really easy. Just juice out your 401k, my friend. Juice out your HSA. That's going to save you. That's 24,000 times 20%. That's 4K right there that you can save. Right.
What, say we're getting towards the end of the year and you know you're going to have a big chunk of money because you had a good year. And you mentioned, you know, just write-offs with no ROI. But there does come a time where, okay, I could send $100,000 to Uncle Sam, or I could use $100,000 for this. What are some examples of those dollar for dollar things that you'd rather go buy yourself something rather than send it to Uncle Sam?
Oh yeah, for sure. So the big thing that, you know, we really see is for businesses themselves, right? Is, you know, any type of business reinvestment, whether it's from the social media to your brand, to mentorship, to coaching. That's going to be big. If you're under $25 billion as a business, check out your inventory. What can you replace and replenish that you know you're going to have to use next? Those are dollar for dollar on the taxable income side, not the tax liability side.
Okay. Yep. Is there anything on the tax liability side that's dollar for dollar?
Tax liability, it would only have to be tax credits. So your tax credits, they're limited on what you can do. The solar tax credit, the EV credit. There's also investment tax credits that you can do. So it's only, the only things that are dollar for dollar on the tax liability side is going to be tax credits. There's 401ks. They give you tax credit for that, for starting one up on that side. Also hiring, you know, people that, you know, just came out of jail, having a hard time finding a job. There's special credits for hiring those folks. So there's some small credits, but business reinvestment's always big. If you're running ads, that's always big. You know, pay your full annual membership for whatever software. Say you're doing, I don't know, like Google Drive or whatever, pay the whole thing for the whole year. That's going to be big there. And then if it's year end and your real estate professional status or short-term rental, that's why you want to take action now and spend and plan now on it. So that would say that's another great area. And then Augusta rule, if you didn't do the Augusta rule yet, do the big Augusta rule. That's like non-cash expenses. You're just moving them around.
Yeah.
So areas, and then last but not least is always this retirement accounts. That's your last Band-Aid option. And then, really plan D, plan F here is this, if you start up that foundation or you want to do charitable contributions, that would be in your next big area of opportunity for you. Donor advised funds is very big that we see too.
Mm-hmm. Got it. Wasn't that, I was under the impression like the farm vehicle write-off was a dollar for dollar thing.
Oh, farm vehicle. Oh, that one, we don't have a lot of farmers. It's fine.
No, but I mean, that's what they called it. But if you bought say a Range Rover over a certain weight.
Oh, Section 179. Yeah. Mm-hmm. Yep. Section 179. Yeah. So if you want, actually, when I did grow up in Minnesota, you'd always notice in that fall, when farmers had a good harvest, they would always have new F-250s. So you could do Section 179, so you buy a $100,000 truck, and you only put down $10,000 down. You finance the other $90,000. You still get the full $100,000 as a deduction. So that's reducing taxable income, but not tax liability. Indirectly, it reduces tax liability. So if you're like me in California and you're paying 50% taxes, that $100,000 truck is actually going to save you $50,000. So it's whatever your spend is times your tax rate. That's how much you save on taxes.
Got it. Okay, I'm gonna try and test you right now. Okay,
I will try. Hopefully, I pass. I'm gonna fail.
I have a buddy, and he's done very well for himself, and he bought a jet. I think it was 14, 15 million bucks he paid for this jet.
Oh wow!
And he explained to me that he basically had to because of his tax situation. It was either he was going to send all this money to the IRS or he could own a jet.
Okay.
And he explained it to me, and I was like, I just didn't want to act like I didn't understand. So I just kind of nodded my head. Oh yeah, I get it. I guess I'll just cross that bridge when I get there. But do you know what that means? Like why it was more beneficial financially for him to buy the jet than not?
Yeah. So I'm going to just assume that he had the right business purpose, intent, documentation, all that fun stuff. But yeah, let's just say that he had, $15 million in net profit on his business, and that jet was 15 mil. And let's say you do 20% down, the bank's going to finance the rest. So you did $3 million out, right? Versus having paid 15 million at 50%. So that's 7.5 million he had to pay in taxes. Now he's arbitrage $4.5 million now because he doesn't have, now he's getting a free loan from the government. He pays down the jet. He's going to save more of his time, make more money. So that's where you can arbitrage. And this is where you rob Peter, pay Paul is how the tax code works. So essentially that's what he's doing, just arbitraging money.
Okay.
Leveraging money smartly, just like real estate investors.
So he put 3 million down. So he has debt on it, 12 million.
Yep.
But he can write off all of that, the whole 15 million against his taxable income.
Exactly.
So now he's not showing a $15 million profit.
Nope. Exactly. He just went down to zero. And then now if it's 15 million, is zero profit, zero taxes. So you pay no taxes.
All right. Okay. So that's dollar for dollar then, right?
Oh, yeah. On the profit side. Yep. Yeah. If that's what you mean by dollar for dollar. Exactly.
Yeah. Okay. So on the profit, like a really good year.
Exactly. Order of operations. Like you start with that, and then whatever your taxable income's left, then you times that by your tax rate. But if it's zero, it's zero. Yeah.
Okay. I'm sorry if I was using that wrong terminology, but now okay.
Oh, you're all good, my friend. I'm just a technical CP nerd over here.
And that's okay. And you have responsibilities and you have to say the right things over there too. So
yeah,
I just get to pretend to be one on a podcast. Cool. All right, man. So if you're going to make one prediction over the next 12 months that you don't think most people are paying attention to, what would that be?
Oh, the biggest thing, most people are not, they're probably 5% population, but AI wave is here, my friend. You're either be left in the dust, you're going to be defensible against it, or you're going to dominate. We're headed towards to dominate over here. But the biggest thing is that AI is here to replace many things. I just was recently at an AI conference. There's humanoids, robots, literally assembling BMWs right now. FedEx has hired them. So it could be working all the time here. And then same thing from our space. AI is here to do transactions. They can pick up the call, put you up on calendar and go. We've been testing some tools that help with the tax prep even. They're not there yet, sadly. Like I wish I could save a ton on labor. But yeah, AI is here to enhance, right?
Right.
People are like, oh my God, it's so scary. It's not. It's an amazing tool. Harness it and take advantage of it. So that's big on that side.
Yeah, that's I certainly have. I don't even know what my life looked like before AI now. That's how much I use it.
Exactly. Exactly.
It's like my phone, like, and it's like the internet. Like, I don't even remember what my life looked like before. I used to have a pager. I really did. And, but I still don't remember, like, so what did I do with the rest of my time? I didn't sit there scrolling through my pager all day, but, you know, cool. Yeah. There's a trend. You'll notice this on YouTube every once in a while. Like, you'll get 20 different creators all creating kind of the same type of video, right? And one of those videos, that trend that's going on right now, is the only 5 jobs that will exist by 2030.
Oh, is that it? Is that a video?
Yeah, so a lot of different creators are doing their version of that right now. I haven't watched it yet. I'm just like, okay, I'll get to it. Everyone's going to do it. I'll get everyone's different perspective. But I am curious as to what those 5 jobs are going to be. So they got my curiosity piqued. It's got to be roofer, right? That's got to be one of them.
It's a hard one, right? Yeah, exactly.
Yeah, I don't know if the robots can get up on the roof and do the shingles. But anyway, it's been a pleasure. Hey, if someone wanted to get in touch with you, Tony, what is the best way for them to do that?
Yeah, best way is just our website, go.thecpadude.com. That's go.thecpadude.com. And then Instagram, the CPA Dude. We're everywhere there. And then if you want to text or call us, 254 CPA Dude, 254 CPA Dude. So all our social media is the CPA Dude.
That's awesome. That's good that you got that. It's hard to get those these days.
Oh yeah. Yeah, we got lucky when we came into this space.
Yeah. Not too many CPA dudes out there.
Exactly.
A lot of CPA guys, no CPA dudes.
Exactly. We're one of few, yeah, or one of one actually, I think, yeah.
Yep. Well, hey, you got the .com, so it's you. You're the one.
Yep. Exactly.
All right, Tony, it's a pleasure. Let's stay in touch, bud, and I wish you the best. And yeah, we'll talk again soon.
All right, sounds great, Matt. Thank you for the time here today.
You bet. Take care.
A lack of capital has killed a lot of dreams, but only for the people who don't know the loophole. If you have a 680 credit score or better and could use up to $150K at 0% to kickstart your next venture, get approval in 30 seconds or less, and you don't even have to talk to anyone at loopholelending.com.